Hi everyone, my name is AJ Singh, CPA from GNS Accountancy, and today we're going to be talking about internal management accounting reports. Outside CPAs or accountants normally provide reports in the form of financial statements or tax returns which are provided to third parties usually for either lending or investing decisions. Today we want to focus on internal management reports that can help provide insights and guidance for decision making. So we're going to be looking at different internal management accounting reports, then how to implement a new procedure, process, or even a new technology in your organization so you can achieve greater efficiency. So these internal management accounting reports can be used across various industries, for example, in retail, construction, freight and logistics, trucking companies. So let's talk about the first type of report. This is called a budget. You compare the budget with actual reports. So on a monthly, quarterly, or annual basis, you will look at the costs that you want to control. You will set some realistic goals on your budget. So in your budget, you will firstly calculate your income. Then you would identify expenses. So for various categories, you'll have many expenses, such as rent, mortgage, utilities, vehicle payments, or even meals and entertainment. So these are examples of some expenses. So the budgets need to be realistic, and periodically on a monthly, quarterly, or annual basis, you will compare your budgeted costs with actuals, so what you actually spent on those expense categories. So you will monitor your performance against your financial targets. So a budget will help you control your spending, save money, and achieve your financial goals. The next type of report is a break-even analysis. So break-even analysis helps you determine the level of sales you need to cover your costs. Another report is a product or service line profitability. A very important report is a product or service line profitability. This will help you identify high and low profit areas. So within a business, this can be broken down. A retail organization may want this report for each store or department. A construction company could use a job profitability report to see which jobs are most profitable and which ones are not. And a trucking company could find out which trucks are more profitable and which ones are not. So a trucking company may discover that a particular unit or truck is losing money because it has more repairs, or it has a driver that continuously loses money on a particular unit. So this type of report may help a trucking firm to decide whether the unit needs to be replaced or not. So a construction company that operates in different segments, they could create this service line profitability analysis. Let's say that they operate in residential, commercial construction, and they also provide renovation services. They may discover that the residential construction is more profitable and the commercial construction segment is not as profitable, not performing as well. This type of report could provide more insight into the commercial construction segment, and therefore construction company could then go about resolving those inefficiencies. They could also shift focus to those other segments like the residential segment, and maybe they could reallocate the resources from the commercial construction to the residential where there's more profitability. So this type of report can provide many insights. Key performance indicators are specific metrics that a business will use to track progress towards their goal. So a retail organization may develop their KPIs as the number of transactions they process or the average value per transaction. Maybe their target is to increase their overall revenues. So these would be the KPIs for a retail company. The key performance indicators for a logistics firm could be fuel efficiency, or on-time delivery rate, or driver turnover rate, or even cost per mile. So the key performance indicators will depend on what your goals are, so you can monitor those indicators and compare those to actual results. So the insights that you gain from management reports, what are they? So they'll help you identify areas of underperformance and potential improvements. They'll help you allocate resources more effectively. They'll help you assess and manage risks. So you'll be using data-driven decisions for your growth and sustainability. So once you've identified inefficiencies in your organization, then you will decide on whether you need to change the process, procedures, or implement new technology. Implementing new technology can help increase efficiencies and reduce costs. But when is the right time to consider new software or technology? It may be because your current systems are outdated or not efficient. You may want to also consider the integration of the new technology with your current systems. You may want to streamline a process and reduce manual tasks. Some examples of technology solutions are software that provides real-time data and reporting. For a retail company, it could be inventory management solutions that optimize stock levels. For a construction company, it could be a project management tool, although many businesses can use project management tools, and these can help track progress and the allocation of resources. CRM or customer relationship management software, this will help improve the customer experience. We at GNS Accountancy help our clients with budgets. We help monitor the financial aspects of the implementation process. It's very important to assess the financial impact of new technologies and recommend any adjustments. So I hope after this podcast, many of you will consider creating internal management reports so you can gain more insight and make more decisions based on data and increase efficiency over the long term. I'm AJ Singh, CPA at GNS. Thank you for listening. I'll see you in the next podcast.